Everyone thinks market crashes are about greed. They're wrong. Sometimes it's about pure, unadulterated hubris. In the mid-90s, long-term capital management, or LTCM, was the envy of Wall Street. Run by Nobel laureates and former Federal Reserve vice chairmen, they believed they'd cracked the market's code using complex mathematical models. They saw minuscule price discrepancies and leveraged them into colossal bets, promising investors stratospheric returns. But their hubris would be their undoing, threatening global financial stability. Their strategy was simple in theory: identify tiny, temporary mispricings between highly correlated assets, bet huge on them converging, and collect the profit. For instance, if Shell stock traded for a cent less than its identical dual-listed Royal Dutch counterpart, LTCM would buy Shell and short Royal Dutch. They called this convergence arbitrage. The problem wasn't the math, it was the leverage. By 1998, LTCM had borrowed over $100 billion, controlling assets worth $1 trillion, all to exploit these tiny differences. Their balance sheet was a house of cards built on the assumption that markets would always return to normal, a dangerous delusion for anyone playing with such high stakes. Then came the Asian financial crisis, followed by Russia's default in August 1998. The world markets panicked. Instead of converging, assets diverged wildly. LTCM models, built on historical data, couldn't comprehend such irrational behavior. Their bets went spectacularly wrong. Their theoretical certainties proved to be anything but. Losses mounted at an unimaginable pace. $550 million in a single day, then another $8 billion in a week. Banks who had lent to LTCM faced collapse, threatening a domino effect across the global financial system. The Federal Reserve, fearing catastrophe, orchestrated a $6 billion bailout from 14 major banks, a desperate measure to avert a worldwide economic meltdown. LTCM implosion wasn't just a cautionary tale of a failed hedge fund. It was a stark reminder that even the brightest minds, armed with the most sophisticated algorithms, are vulnerable to market irrationality and their own overconfidence. No amount of Nobel Prize-winning genius can account for the unpredictable nature of human fear and greed. Next, we unravel the digital gold rush that turned into a multi-billion-dollar pyramid scheme.